Hello, welcome to the demonstration on how to calculate leverage ratios in financial statements analysis, and also how to interpret those numbers. Right, so here I do have a selection of some key financial ratios specific to leverage ratios that are derived from financial statements. So in order for you to be able to do these kind of calculations, you need to have a balance sheet, you need to have your income statement, you also need to have your cash flow statement. So those three financial statements are key, and those are the primary financial statements that you're likely to find yourself having to deal with in order for you to develop some deep understanding of how well the organization is actually doing. Again, there are different types of financial ratios. As you know, on my channel, you might actually already have come across a variety of those liquidity ratios, activity ratios, and now financial ratios. Again, I'll be providing additional ones like profitability ratios and market ratios. It does make sense to group these financial ratios into those categories. Then that way you can be much more targeted in terms of understanding the interpretation, and thereby being able to derive some action plans around what the results will actually be showing. Okay, so without further ado, here we have the first one is debt ratio, right? And basically, it's simply telling us how much of our assets are being funded by liabilities. So in other words, how much of our assets are being funded by borrowed money. And in this particular case, you can see for this particular organization over a 2-year period, it was 50%. The prior year is now slightly more than 50%, which is about 52%, right? So over a 2-year period, you're actually able to see which direction this particular organization is actually trending, right? It's increasingly funding more and more of their total assets using borrowed money, okay? Now, again, one can argue that this is not very meaningful. Well, at least here we're just comparing 2 years, so therefore within the organization itself, we can see the trend. But in many cases, if you have industry numbers, then you're actually able to compare the performance of this particular organization with what's happening within their specific industry. So that brings more meaning to the analysis. Okay, so I just want to throw it out there so that you can be aware that if we're going to ask the question why, so what does this actually tell me, right? So at least at the very least, you're actually able to understand how much of the total assets are being funded by borrowed money, right? And then over time, you can actually see if you're trending the wrong direction, you can make some necessary corrective measures, right? In some cases, some people may say, well, of course, maybe if it's cheaper money, it's a question of making that financial decision. You know, chief financial officers, they're constantly thinking about creating value and maintaining value or preserving the value within the organization itself. So they're constantly looking for opportunities where cheaper money can actually be used. Right, so what about long-term debt to total capitalization? Now, this financial ratio tends to tell us more about the long-term solvency of the organization. Debt ratio does that too, right? But of course, when you talk about total liabilities, we are also including current liabilities, which are actually short-term. So, but long-term debt is actually kind of projecting on a long-term basis. Here we are actually seeing that the long-term debt is about 31%. It's actually been averaging 31% over a 2-year period for this particular organization. So in other words, of our debt that we actually owe, including the stockholders' equity, 31 of it is actually long-term. So usually organizations tend to think about long-term debt as long as you can actually match long-term borrowing with long-term projects, right? Because you also want to make sure that there's a good match on that. Otherwise, if it's actually a mismatch, you may need to pay back the debt before the project is actually complete or before the project is actually generated anything at all. So it's always important to match your long-term commitments with your again with the kind of funding you will actually be using. Very important to think about that. Now the next one is debt to equity. So here we're trying to figure out how does internal funding compare with external funding. For this particular organization, it's actually 1-to-1, which means it's evenly split, which means the money, the equity within the organization itself, right, which is from the stockholders who are much more tolerant, and it's obviously cheaper. That's actually cheaper money that we can have access to, whereas liabilities, we pay cost to borrowing that type of money, right? So in this particular case, kind of a 1-to-1, so it's 50-50, right? Okay, again, slightly growing, and again, that's pretty consistent with the previous other ratios we just saw. That's over a 2-year period at least. The trending is actually showing that that way, that there's actually some growth, right? So which means there's more commitment. What about times interest? And so in other words, we just want to see, are we generating enough profit to cover our interest expense, right? So in other words, our operating profit in this particular case is actually can cover the interest expense 7 times during the current year, but prior year it was actually 5 times, right? So how much is good number? Again, it's also depend on the performance of the industry, how you compare yourself with the industry. In some cases, it could just be just looking at the trends. Are we going trending the right direction, or are we trending the wrong direction? In this particular case, we can see that they actually improved from the prior year. So the profit was better, thereby enabling them to have that cushion that they needed to cover the interest expense. What about the cash interest coverage? So in this particular case here, you are actually looking at the cash itself, the cash flow from operating activities, because many times when you talk about operating profit, it has a little bit of a distortion to it, because we make a profit based on revenue that we've not yet collected the cash for, right? So we earned the revenue, maybe we sold something on credit to our customers, but we haven't collected the money yet. So we don't have the money yet, but we can actually declare the profit because we've got the claim on that revenue that that is owed to us, right? So basically, that's the nature, of the business. When we use in accounting, for those of you who are actually accountants, when we use the accrual concept, we are not using the cash accounting principle where we are only dealing strictly with cash, right? So incorporating cash flow from operating activities enhances our ability to really have a better understanding of what our capabilities are in terms of being able to pay our interest, right? Because we are able to link up to incorporate cash itself, the real cash, which is actually more real than just the net income. Yeah, right. So interesting in this particular case, quite volatile for this particular organization. 7 times in the current year, but prior year it was only 1.24 times, only 1 time. So 1 time. So again, may not be very meaningful unless you're actually comparing over a long period of time or you're comparing with industry data. So cash flow adequacy, again, just looking at the cash flow itself, do we have enough cash to take care of our capital expense, debt repayment, and dividends to be paid? For this particular organization, they were in the negative in the prior year, and they are in the positive in the prior, but it can take care of about half of those demands, right? So at 0.58, that's about just over half of it. So again, very, very useful information in terms of giving this organization some idea about their ability to borrow more money, right? In many cases, they're over leveraged or they are kind of on the borderline, on the tipping point, where they may struggle if they wanted to go to the bank and borrow some money because the bank or any creditor is constantly looking at how much leverage do you have in terms of your ability to fund the debt that you would want to take on, right? You actually look at what you currently have, as an organization. very, very useful information. I hope finance professionals, you find this helpful, and also students of finance, you also find this helpful, because this is some of the concepts that once in a while you kind of get lost trying to figure out, okay, financial leverage, okay, what is debt ratio? What's the difference between debt ratio and debt to equity? And what is long-term solvency of the organization, the long-term debt to total capitalization, right? What are our long-term commitments? Are we matching them with the projects that are also long-term, right? Because you want to borrow money on a long-term basis to fund a long-term project too, right? Than to fund a short-term project with long-term, funding may not make much sense, or vice versa, right? So you're constantly thinking about that. Of course, that's that's the main responsibility of for those who are in financial management. As you go higher, constantly looking at that type of responsibility, fiduciary issue of a responsibility of understanding how much or how much value are we creating as an organization, and are we preserving it, and what are the opportunities to grow, and how are we placed in terms of being able to fund new projects. Can we fund them internally, or can we get some cheap money from out there, right? Again, it's also dependent on your leverage. So by looking at these leverage ratios, you can really make a very nice determination whether you are in a good place or not. Otherwise, that's all I have for you. I hope you found this video insightful. And of course, if you did, like the video, share the video, and be sure to subscribe to the channel. That's all I have for you. Bye for now.